Good morning. This is Jim Harvey, president of Opus 111 Group, and this is your Money Week. This week I want to talk about opinions and pundits and who do you listen to with all of the differing opinions out there. And I'm going to highlight two fairly prominent market pundits on Wall Street, Nouriel Roubini and Ed Yardeni. This is a challenge that we have, but also all investors have, is, there are so many opinions out there. They all seem very legitimate. Which one do you listen to? And part of the reason why people like me exist and professional financial advisors is to help people navigate those kinds of challenges and, make decisions based on what they think is right. So let's start with Nouriel Roubini, who right now is saying that all the talk about a recession being, shallow and not very significant is absolutely dead wrong. If you look at the history of this gentleman's predictions, and there's some other people in the past that are sort of just like this, they're always the negative voice. They see disaster in everything and that kind of thing. And to give you an idea, he called for a recession after Hurricane Katrina in 2005. And then he consistently has called for either recession or depression until 2017, when he totally disappeared. But the one period of time where he was correct was in 2008. So let's hear what he has to say first, then we'll look at Ed Yardeni. So what he's basically saying is that, we don't know when inflation's going to peak. What we're going to face is a stagflationary debt crisis combining the worst of the 1970s and 2008. And, there are other people that are predicting some things, but he's also saying, it's unclear whether the Fed in its quest to slay the inflation dragon will raise rates high enough to cause a recession. They're talking about, oh my gosh, consumer prices soaring 9.1%, a 40-year high in the 12 months through June. Inflation is measured on a rolling 12-month period of time. And while 9.1% sounds like a big number, and it is, from 1968 to 1983, inflation averaged 7.6% a year. Again, your context is really important when you're looking at it. Now, former Treasury Secretary Larry Summers was one of the experts who sees a high probability of recession. He says at no time in the last 65 years has inflation stood above 4%, unemployment below 5%, and the economy failed to enter a recession. But he is one of the people, and I tend to agree, that if we have a recession, it's going to be mild. But that's not what Nouriel Roubini said, Chief Executive Roubini Macro Associates. And remember, these pundits are paid to voice their opinion, and they sell subscriptions and advertising, that kind of thing. And so there are a lot of people that follow what they believe. Here's what he says. There are many reasons why we're going to have a severe recession and severe debt and financial crisis. And he said, Roubini's one of the experts who predicted the financial meltdown of 2008 and 9 told Bloomberg on July 25th. The idea that it's going to be short and shallow is totally delusional. Great. He goes on to talk about the 70s. He said we had stagflation, but no massive debt crisis because debt levels were low. Today, we face supply shocks in the context of much higher debt levels, implying that we're heading for a combination of 1970s style stagflation and the 2008 style debt crisis, which is a stagflationary debt crisis. Here's my opinion about that. First of all, debt ain't remotely as high. We are not remotely as leveraged as we were in 2008. So to say, oh, okay, we have the supply chain disruption and high debt levels is really a distortion of the facts. So there's Nick Roubini. He says at as for U.S. stocks, most likely they will plunge lower. In typical plain vanilla recessions, U.S. and global equities tend to fall by about 35%. I think the lowest points it's been since the beginning of the year is down 24. And he says, but because the next recession will be both stagflationary and accompanied by a financial crisis, the crash in equity markets could be closer to 50%. Don't forget that between 2007 and October and March of 2009, the S&P was down 57%, which, by the way, is one of the reasons why we don't really like index funds, because sure, you get the index return, but you also get the risk that accompanies it. Now let's look at Ed Yardeni, who says that the S&P 500 has already bottomed and sees no hard landing. In his view, the S&P's plunge last month to 3,666.77 low will likely mark the trough of the equity rout. Now, his perspective, and I agree with him, underpinning this sanguine call is the fact that corporate earnings look excellent. Savings rates for consumers are excellent. The unemployment rate is very low. And so here's what he said on Bloomberg TV not too long ago. It's never easy to pick a bottom in the stock market, but I'm going to give it a try. The real question is going to be the earnings season. And so far, the earnings season is going reasonably well. It has not really thrashed the stock market, and the stock market held up quite well. So you might ask, well, how's he done in the past? And Yardeni appears to be in the minority in the Bank of America's corporate survey this month, where a lot of money managers said they've cut their equity exposure to the lowest level since the 2008 financial crisis. But at the end of June, a Deutsche Bank poll showed 72% of respondents expect the S&P to fall to 3,300 first, rather than rallying to 4,500. But if Yardeni's track record is any indication, it's worth heeding his view. He worked at Oak Associates and Deutsche Bank before founding his namesake research firm, the Yardeni firm, which we use a lot because they have excellent graphs and data to use to help us provide perspective. He called the equity bottom the same month when the 1982 bear market ended. He then repeated the success in March of 2009 when the S&P reached an intraday low of 666, 3,000 points below this year's trough, in what he calls another devilish number, which I think is pretty cute. While he didn't see the dot-com crash in 2002, he did predict the 1987 bear cycle with Black Monday, which was short-lived, less than 2 months before stocks stage a big recovery. So his perspective is that looking at a second quarter gross domestic product that could turn negative, making it a second straight quarter of contraction, which, by the way, is the unofficial definition of a recession, according to the National Bureau of Labor Statistics. He said he would call this a mid-cycle slowdown. And he basically said, I don't see a hard landing. So how do you sort through that? Well, one of the things that we hear a lot is, well, this time it's going to be different, which is effectively what Nouriel Roubini is saying. Oh, this time it's going to be different. We're going to have the worst of the 70s and the credit crisis. Oh my God, and the market's going to go down 50%. I don't buy that at all. But somebody who continues for 12 years to say we're going to have a recession, we're going to have a depression, a broken clock is right twice a day. And I don't really think that this guy, his argument holds any water. Could I be wrong? Sure. But this idea that this time it's going to be different is as basic to human nature as almost everything else when it comes to behavioral finance. And that's really what we do a lot of studying on, is what are people doing? Now, if corporate earnings were terrible, if unemployment was high, and the supply chain was disrupted, I might lean more towards Roubini. But Ed Yardeni is a guy that I absolutely think is a data-driven person. He really has no reason to go out there and be a prediction guru, whereas Nouriel Roubini is basically saying that, you should listen to me because I'm right. Well, after almost 40 years of doing this, I can tell you very infrequently are people right. And if they are right, there's the old phrase, even the occasional blind squirrel will find the acorn. Bottom line to me is we're going to go into a strict recession if we don't already have one, with 2 negative earnings growth or growth in the gross domestic product of the United States. That doesn't mean that it's going to be a severe recession. It doesn't mean we're going to have the great recession that we did in 07, 08, 9, 09. It doesn't mean we're going to have a Black Monday event like 1987. So keep your bearings, folks. Talk to someone who might be able to provide you a little bit of context for this kind of stuff. When I first got into the business, if you wanted research, you had to come to a firm like us. When I first got into the business, if you wanted to sell or buy a stock or a bond or a mutual fund, you had to come to an advisor. Now people, are sporting fintech apps so you can trade and do all your budgeting and all this stuff on an app, which is a remarkable technological achievement. But it doesn't change the importance of making sound investment decisions that are based on facts, not hyperbole, and not listening to people who make their living by scaring the bejesus out of everybody. It doesn't mean that Nick Roubini is wrong. He could be right. I just don't think so. Anyway, if you want to learn more about our firm, and we invite you to go to our webpage, which is opus111group.com. In particular, go to the Learn page of that website, and you will find written blogs, audio blogs, and video blogs like this that hopefully will provide some perspective and help you make more informed and less reactive investment decisions. Thanks for your time. This is Jim Harvey, president of Opus 111 Group, and I'm hoping you have a great day.